welcome. I'm Pooja Sarkar and you're watching Capital Ideas, our latest podcast from Forbes India. It is our endeavor to bring you conversations with leaders in the world of business, economics, finance, and everything else in between. And we really hope that you like these conversations. Please do like, subscribe, follow us, and be a part of our journey. In fact, if you prefer just to listen to these episodes, then please go to Spotify and Google Podcasts or any other podcasting platform that you prefer, and you can find us there. Now, today is our third episode and we are steadily increasing our episodes, and I really hope that you like them. And today I have with me Ranu Vohra, Executive Vice Chairperson at Avendus Capital, to speak to us about his journey, this entire entrepreneurship journey since they started Avendus Capital as more or less as an investment banking firm, which has now grown on to become an entire full stack financial services firm with offerings in credit space, funds, long short fund, everything else that they are doing. And also one of the raging questions these days, is there a market correction coming in? So I really thought let's get Ranu to speak to us about all these topics, and we really hope that you enjoy these conversations, and please do become a part of our journey and share us with your friends. In the last few weeks, I think you've come up with this whole change in leadership roles, and you have clearly identified X, Y, Z for all the founders. What are these happening at Avendus?
I think Avendus is a larger organization. I think it's an organization which, if you look at what we were 5 years back and where we are now, there has been tremendous growth in the organization. The organization was, whichever metric you use from a revenue perspective, profitability perspective, headcount perspective, we have been anywhere between 3 to 5 times of where we were 5 years back. I think when you realize that when you have had this kind of a growth, you need to just step back and see what do you need to do over the next 5 to 10 years. How should you play out? And I've been fortunate enough to have my two fellow co-founders, Gaurav and Kaushal, who have been, with me in this journey. So we actually kind of sat down about 6 months back and said, how do we reconfigure the organization? Very specifically, there are a few things which are brewing. One is we realized that a lot of clients have started touching us in ways more than one. Right? Mm-hmm. We were about, if someone had asked you about 7 or 8 years back, what is Avendus? Very likely you would have said, oh, it's an investment bank doing this. So, and you would have rattled a few transactions. And I think what has happened is the last 5 to 10 years have been a journey in which we have several other businesses which have started and which have become meaningful. Our alternative asset management business, we run the largest hedge fund in the country now. Our wealth management business, which manages more than 1,200 families, monies from them, getting to about 30,000 crores. Our credit business, where we have been impactful in our own way in the mid-market ecosystem. So I think we've kind of done a few of these things, but and clients have been associated with us across businesses. So it was time that we said, how do we offer the firm as one Avendus to our clients? Likewise, for our leadership, how do they collaborate? How do they synergize with each other to give the best possible outcome? So we in some manner, rejigged our roles to make sure that, we have clear responsibilities for specific areas. And, how do we kind of just get the one Avendus agenda out there? So I'm going to be spending a fair amount of time with the clients of the firm, with the leadership of the firm, and just thinking about how the firm can be brought together as one. So that's exactly what is there, and Kaushal takes charge of the credit business as its MD and CEO, and there are several connects of that with our other businesses, and Gaurav becomes the CEO of the business. He has several areas to look at, but with our enterprise, we have someone who has to be responsible for numbers across businesses. So he takes that responsibility.
Okay, true. Is it more like a journey towards an IPO?
IPO is, I had a discussion with my management team, call it about 2 years back, and they asked us, what are your plans to go public? And we are not close to the idea of going public. We have never been close to the idea of going public. We have been a private company for 21 years now. But I think there are a lot of things which have to align for you to go public. And we are in no hurry to go public. Our stakeholders have been very supportive. They are not in a hurry to push us to go public. So the things which have to align is our businesses have to reach a stage where we are comfortable with their growth, and we have to be comfortable with how they're de-risked. We have to be comfortable with what kind of predictability we've established in our business from a profitability perspective and from a revenue growth perspective. And we have to see whether the businesses have reached a certain stage in maturity with which to go public. At the heart of it also is a certain philosophy that we don't need to be public as a small company. I think we need to get to a certain minimum critical mass to touch the public markets. So I think those are things playing in our mind, and some of those things will play out hopefully. But no, this wasn't done with an intention to go public.
Okay, I'll take your word for it. But there's one thing I wanted to understand. You've built. I mean, you're professionals who have become entrepreneurs, and you've built this entire thing. These days, you've seen a lot of entrepreneurs either selling out the business too early in life, or the second biggest challenge has been scaling up. But if we look at the financial services business, if I also look at, for example, an IIFL, you look at Venkat Ramansa or Nirmal Jain, who are also professionals and who build these businesses. Some of you guys have actually been able to build this large scale business and scale it up. What are the biggest challenges that are there in scaling up, and are the challenges different from what they are today than you saw in your time?
Well, the challenges at one level continue to be the same, right? I think the challenge is about the availability of talent, availability of right leadership. And what we have seen is in businesses where we've found the right leadership, we found the right talent, things move faster, they scale up faster. Also, scaling up is a journey, right? You have to get something right, and on the back of it, then you can construct other things. And so, it has taken us almost 15 years to get investment banking to a part where we can say it's a scaled up business. It took us long. Similarly, in some other businesses, things moved a lot faster because we had capital, we had the right leadership, we had the right processes, and so whether it was alternative asset management or the credit business, we were able to kind of scale up our business in a meaningful way over the last 5 years. So I think it depends on what kind of vintage you have for the business, right? Are you fighting against the wind? Is it a tailwind or a headwind? That counts a lot. If it's a tailwind, have you been able to put all the levers in place for the business to grow and scale? Have you put the processes? Have you done the risk management? For example, if you've not done the risk management in an area like a credit business, for instance, if we had been, kind of, let's say, call it extra generous 2 years back in doling out credit to the market and being not too sensitive to the risk, we would have had a different situation today. They would have to take a step back and then step forward and step back and step forward. So the biggest enemy of scaling up and compounding is if you have to step back, right? If you have to take a step back. So the markets as it is, the macro environment as it is throws enough challenges at you. So you have to have a strategy which is where all the levers for scale are built. The processes are there. You need to have leadership which can delegate tasks rather than actually try and control things. Again, if you try and control things too tight, you can't. You might have a good boutique franchise, but establishing something of scale is difficult. And the last thing I'd like to say is that scale is not the only thing which excites us, right? Sheer numbers thrown saying, oh, I'm 100,000 crores here and I have these is not meaningful. In fact, the way I'd like to divide the world is that I see either a business as visible or relevant or dominant, right? Dominant is where, we are among the first or the second in terms of mind share, right? Relevant is where we are among the top 5. And visible is where we exist in the business, but we don't have a real calling card in that manner. So it's a journey for each of the businesses, to get to that point of relevance and dominance where, then it can become interesting enough. So are the challenges different than what we saw earlier? No, as I said, these things were always the same. I think what has happened is that over the last 15 years, we've had varying macro environments, and it's not been easy. For instance, you recall the period from 2009 until 2014, which was a kind of a period without any tailwind. And then there was a period post 2017, which was again without tailwind. We had periods of time where international investors had no liking for India. So whoever you would go to asking for money for your funds would have a view on India, which was difficult to kind of negate or difficult to defend. So those are things which have counted in the past, but I would say more macro than micro, and we have been focused on just setting up the right foundations for our businesses rather than just try and be in a hurry to scale them in the second year itself.
True. Now coming to the part that over the you've done this over the last few years. All of been noticing it that Andrew Holland came on board, and then you're building another business vertical from stepping away from your core, the heart of Avendus, which was said to be investment banking, and then stepping away. Then you also have a hedge fund now. You had that fund called Zodius. There's so many things that are happening at Avendus when it comes to funds and asset management. If you can take us through what really is happening, how is Avendus scaling these growth wheels?
Sure. So I would say that, asset management, the idea of asset management and its relevance to us at Avendus is not new. It didn't start 3 years back. I think what we have been very focused on in asset management is to get a good space where there is value and where you can play long term. I think that's very important. And it's important to find a strategy, a defensible strategy, which your competitors and others are not following. Let me give you an illustration. We found that the public equities, the whole long only public equities market was in some manner, from my personal perspective, as I looked at it, it looked like there are a lot of white spaces. There was space for a highly process-driven, rigor-driven, investment house, rather than just a superstar-led investment house. So very often, money follows people. Right?
Yeah.
Oh, that guy's a rock star, I want to give him money. But those are things in the past which people have realized do not work, because the moment performance is seen over a 3 to 4 year period, that illusion of that person being an exceptional person is either, very often turned false, from what you initially imagined. So we've tried to kind of carve out a space for ourselves on the long only side, where we are saying we will be an institutional, process-driven, investment house. And how did we do it? We had to we had to have a leadership in place for that. We had Tridib Pathak, who joined us from Enam last year, and Tridib brings with him not just a perspective of handling alternative funds, but he's handled large portfolios for some of the larger institutional funds globally. So when he comes with that perspective, and we offer that perspective to families in India, it's a very different feeling for them. Right? They see it in the way we communicate with them, they see in the way we invest. So all of that came together in the long only side. Likewise, we have, let me talk about the hedge fund, which I'm sure you've heard about, and probably one of the fastest growing alternate funds in the history of the country. It was something which, coming off on the back of this deal with KKR in early 2016, we had a discussion with Andrew and Vaibhav and Alok Vajpayee and team, and brought them together in end of 2016 to specifically to look at an area which is the absolute return funds. And the long short funds, and the way Andrew Vaibhav have managed that over not just for a year, 2 years, 3 years, but a track record extending more than 10, 15 years, was very unique for the market. There were no products like this. There was either pure equity, there was a pure debt. So we came in a category, we said, this is debt plus. So you have monthly liquidity, you get something which will probably give you 100 to 200 basis points more than what you would get by way of other liquid products, and safety wise, volatility wise, comparable or better. So that product caught on to people, and people started believing in it. And as I said, there was a point of time we had to literally close the tap because there was too much capital trying to get into that product. And we were fortunate. Now, what happens is some of these things have a certain trajectory, and then some events happen which either completely throw the ball out of the park, or this was demonetization. When demonetization happened, all of a sudden people started having a relook at their asset allocations, and that was the time when the absolute return fund came on its own and became one of the largest funds. It currently has more than a 65% market share. We, on the back of that, built another variant of this, which is an equity minus variant. And so what has guided us towards putting these products is we would not do things unless we found there to be a clear, sustainable, long-term space in that area. If it's not long-term, it's not for us. If it's just momentum, it's not for us. If it's like, you told me that, oh, this asset looks very attractive, why don't you build an asset management business? And I could not see, if I am not able to see a 2-year sustained future for that product category, I would not raise money for it, even if I was getting money. So we've kind of shied away from making those kind of decisions. Similarly, on the private side, we felt our USP is our understanding of private companies, entrepreneurs, their growth trajectory, how entrepreneurs behave in certain environments. And we created a product, for instance, called the Future Leaders Fund, which is now where we felt that while private equity funds start looking for 15, 20, 25% stakes in companies, very often there is a stake available which is 2 to 3%, right? And no one wants to vie for that stake. How about creating a pool of capital which would just get that stake? Ultimately, stock is stock. Just because 15% is available in a company doesn't make it more attractive than a 2 to 3%, because the 15%, the inherent assumption getting in is that you will help the company, you will value add to the company. Whereas this product is slightly different, where we're saying value addition is for us not the objective, the going in objective there. So we created that. Likewise, Zodius on the tech side. So the idea has been this underlying thread has been that we will do things very sparsely, very few things we'll do. So we have, as you can see, we have long only and long short on a public equity side, and tech and consumer on the private side. So we've not tried to kind of put our feet in like 5 areas, 10 products. So we are as founders, we have been very conservative in terms of adding areas. And to date, after 21 years, Avendus is just about these 4 businesses, and that too closely interlinked businesses.
True. This one thing I want to understand, when it comes to public markets, if you look at it, it does not reflect that we are in a pandemic, or it does not reflect anything that is really happening on ground in terms of economic indicators. But when you look at a private company trying to raise capital, they do know that there is a pandemic that is happening around us. How do you connect the dots when it comes to valuations in the private market versus public markets right now? And how do you see transactions happening? Because you understand, you always have caught the nerve of the M&A industry. So what is your view?
Well, I think one, there is a correlation or close linkage has to be between the private market and the public market. So there is but let me put another case to you. There are so many digital and tech companies in the private universe, but there are very few digital and tech companies in the public universe.
True, exactly. I was going to come to that we don't have any listings that is there, like you see an InfoEdge or an India Mart, but other than that, there is not really any company that we've seen come and list in the Indian market at least. But if you look at the tech market, the tech stocks in US, we are just inching upwards.
Absolutely. So, yeah. Absolutely. So I think that's and the other part which I'd like to kind of submit here is that if you look at the value equation, what was the value of private companies versus public companies 10 years back? right? Private companies would have been a much smaller percentage of the market in 2010. In 2020, the private company valuations and public company valuations are getting more and more now balanced, right? If Byju's does a transaction at $10 billion, Flipkart does a transaction again at $15 billion. So you can see that, and there are at one count more than 34 unicorns. So which means that effectively there is a sizable amount of value which is now built into these private companies. So as an investor, I want to get into an area, a part of the economy. For the first thing, I have to see whether there are any companies which represent that area which are there in the public universe. So the public universe, you would find that certain bets you can't just make; you have to make them in the private space, and hence the demand supply and the valuation will reflect that. Okay. So, for instance, in education, edtech or health tech today, the valuations are in some manner, it's a reasonably hot area of the market.
Mm-hmm.
And that's because I have limited choice in terms of which companies, leaders I can go to. There's also a very important facet that in most of the digital and tech businesses, there is a very sharp drop in value from the leader to the second to the third player. So as a result, you could be in certain industries, you could be the 15th player and be a meaningful player. But in this case, if you are a 15th player, God help you. There's no, there's very little in terms of future. So effectively, you have to. There are fewer companies. Those companies are the companies which have established themselves among the top three, have shown how they have used capital, and are more and more expensive as they raise capital. Okay. So now on the public side, I would say that public equities is also expensive, but it's expensive, I would say, for a different reason. And I think the reason is that we are living in my mind, what is a bubble today. Everything to me sounds a little virtual, a bit of a bubble, because there is so much liquidity thrown in that it is impossible for us to see what is working and what's not working. And I think at some level, so much of liquidity thrown into the system is going to have is going to show itself and manifest itself in the right way, maybe in a year or so. So effectively, what you are seeing, in my mind, could be you could see an enormous amount of volatility in the market next year. Enormous amount of volatility, maybe starting end of this year, and it might be good to exchange notes after a year to see which stocks actually and what part of the capital market is actually doing well or not. But overall, given the way things are, I think the market has been way too optimistic. And if you were to very simply lay out the earnings growth and the corresponding valuations, I mean, it doesn't make sense. I think it's the market is expensive.
Yeah, exactly. That's what I wanted to understand, because if you look at any company, how do you actually determine the growth that they would have? For example, like today I did a story, it's come out, which talked about how everybody says that, hospitals are making so much money. But when you look at the listed universe, I realized everybody has clocked losses of over 100 crores. Any of the top 3 or 4 large listed, everybody in the large listed universe have actually reported such massive losses. And we are not talking about 10 crore, 5 crore. We're talking about hundreds right now. But if you look at the stock prices, they've gone up 25%, 35% in last 2 months. So how is it that, there is any semblance of sense on any of these transactions that are happening in public markets?
Well, I think one should, and there is it's an interesting bias we have, that we try and assign one reason, right, to why this could be happening, or a couple of reasons, or try and find a cause. It's very difficult to find a cause for this. Liquidity, as I mentioned, is one of the big causes why the public market is currently in stratosphere, or whichever way you look at it. So I think just take away these temporary issues, take away the fact that 3 months of this year have been a washout. So most companies between April and June have done precious little. It's only July that companies' revenue started kind of, getting marked as a percentage of their pre-COVID levels. right? And by various yardsticks, to get to a pre-COVID situation might take right until December 21 or until March 22 to get to. So if you factor all of those things in, you realize that there is a temporary imperfection, there is a disconnect in the market, or there is more hope and optimism going around. And I think the other part is that there isn't just enough areas where people can allocate their savings. So, gold now is becoming a beneficiary. But if you look at other areas, you'd find that real estate, for instance, has been a huge kind of is deprived of capital. No capital is going in. So there are very few avenues where you can invest capital. Your fixed deposits, liquid funds are giving such low returns that most people will not expect that these will actually help them even beat inflation. So I think that's the problem. So I think the problem is that right now equity seems to be the only area where people feel that they can get over a 5-10 year period a 15% kind of a return. So that's what they're betting on. There's also a bet at some level that things might return to normalcy sooner, but I have my reservations on that.
True. And coming to the part, when it comes to the future of Avendus, what do you see as the future of Avendus?
I think the future of Avendus lies in how best we can work along with the companies in this country, the entrepreneurs in this country, and how well we can align ourselves to their needs. Right. I think there is going to be a very high need for advice, financial advice, and given we are building that business brick by brick over 21 years, we are the leaders in that space. I would be surprised if there isn't a very bright future for that business, because it's just going to now, by every yardstick today, there are very few choices available to a good company. If it wants to hire the best, investment bank in the country, there are extremely few choices. So it's in a market where you're dealing with a very low fee pool, right? So growth is a certainty. On top of it, if you're a premium investment bank, then more entrepreneurs would like to come to you. So I think that's there. I think, if I look at the wealth management business, asset management business, credit the way it is, coming off the issues which we had over the last 2 years, in terms of island FS issue, the other financial sector issues in credit. I think it has reached a point where the industry is getting disrupted, the industry is evolving, and there will be growth, but the growth will be available to those who change their business models. Growth is not a certainty for people who have not changed their business models. So if I were to look at wealth and I were to do what I did in the last 10 years, will I get there? Answer is no. I'll have to change. We'll have to bring in technology. We'll have to bring in specialized products. We'll have to find an innovative way of dealing with clients. That's how we'll get there. We'll not get there by using techniques and tricks of the past. So I think what the future of Avendus to me is not in terms of, again, just creating multiple businesses over and over again. I think the idea is, how do we become deep, meaningful, players in each of the areas which we have kind of focused on so far, and as I said, get leadership and mindshare.
True. And what has been the impact of COVID on Avendus, and how do you see the impact on the financial services business over the last few months? And also, did you ever think you'd be home for 5 months?
It's interesting, and let me answer your second question first. I think going into the lockdown in March, I still remember when the lockdown was announced, and we all felt that it's been done at a time when the numbers and counts of COVID positive patients is low. And so possibly that's all we'll have to take, the 3 weeks, and we are back at work, and life will be okay. And it's not just us. I think everyone thought that this is something which is few weeks and then we're going to be back. But that goes to show you how remote we are from the reality, and how hopeful we are as a
human beings.
speeches because you know they say that when people were asked in 1914 that how long will the world war last, most of them said a few weeks or months, but lasted for as many as 4 years. So I think we just tend to underestimate, and even at every step, the this disease has surprised us, and so yeah. So never I had an idea of how uh, COVID would affect us. What was your first question again?
The first question was, how has the pandemic affected A, Avendus, and B, financial services?
Yeah. So I think the way it has affected Avendus is that uh, there are pockets which have proven to be anti-fragile in Nassim Taleb's language, and that level of anti-fragility has helped those businesses grow far faster than anyone expected. Right. So new areas have come into the fore. Uh, Digital and tech is a winner because at the heart of it, digital and tech businesses are fundamentally made more robust. They're more startupish. They can change things around. They can pivot as compared to old traditional large organizations which were dependent on a retail outlet or a formal distribution mechanism, which was so. So I think what has helped Avendus a fair bit is that the clients we were serving have actually used that opportunity to grow faster and hence raising capital for them, doing M&A transactions. We closed the JB, chemicals transaction, JB Pharma deal, way, uh, way into the pandemic. So there are areas like healthcare, there are areas like digital and tech which have done well and continue to do well. And I think in other businesses like wealth, we have used the pandemic as an opportunity to get closer to our clients with our new leadership with Nitin Singh as the leader. We are constantly redefining our proposition, what we need to do. On credit, we have gone back to the drawing board and said, this is the new world. Which of the companies is doing what now? How do we help companies which are our portfolio currently? And what would we do with incremental lending? At the same time, we boosted our cash reserves. So that's been a big thing. I mean, in credit business where cash reserves are important, we have increased our cash reserves substantially to ride any kind of volatility in the markets or any moratoriums which might be extended. And we have honored and we have a portfolio which has zero delinquencies. We have, with all our lenders, we have been more proactive in going back to them and saying, if you need your money back, please take it. So which I'm sure a lot of people in this market weren't contemplating. So we have changed the rules by way of which the brand was seen in the market. And yeah, so in asset management, for instance, we have kind of bolstered the core equity portfolio product with Jadip. We've come up with an absolute return PMS plan to which goes well with our leading AIF in that area, and which has garnered a significant amount of investment already. We got some of our clients in very promising digital companies, wealth clients into digital companies. So we've done some very interesting things. We are experimenting all the time. We are, and it's been fun to kind of see that disruption and see how will we take up that challenge.
True. And you were mentioning that you've read a lot of books over the pandemic. Before you go, I want you to give recommendation of 3 or 4 books that you would like people to read.
Okay. So I would, again, this is something which most of the audience might have read, but I would say Anti-Fragile by Nassim Taleb was a good one, which I read. Atomic Habits by James Clear, very good book which talks about how incremental changes can improve you as a person, and making those minuscule changes in you every day can make such a big effect. And then A Gentleman in Moscow by Amor Towles. 3 books which really I like reading. I've read a bit on philosophy and classic literature as well. So, but those are books which everyone knows about.
Okay, great. Thank you so much for your time today, and all the best for the future. And I hope that when the world gets better, we get back to meeting each other.
Absolutely, Pooja. Thank you very much. It's been nice talking to you.
Thanks. Bye. Take care.
Bye.